5 tips for limited company directors when applying for a mortgage. Tip number 1. Lenders view limited company directors' income in 2 main ways. Most lenders will take the salary and dividends that you pay yourself, but there are a handful of lenders that will look at the salary plus the net profit of the business. Now, if you've made a lot of profit and you've kept the profit in the business and not paid it out as a dividend, then this type of lender can be the one for you. And it means usually, not always, that you can borrow a lot more money. I get asked by directors all the time, should I be paying more dividends to help with my mortgage application? And in a lot of cases, my answer is no, because we don't need to use the dividends. We can use the net profit instead. The net profit includes the dividends, but also includes profit left in the business. Tip number 2. Liabilities can outweigh the assets. If your liabilities are outweighing your assets, then lenders see this as risky and potentially not sustainable. Most lenders do not want to lend to you in this scenario. Now, if you're applying for a mortgage, please check your accounts. Please speak to your accountant and, of course, your mortgage broker to see if this applies to you or not. And speak to your accountant to see if anything can be done to fix this. Tip number 3. 2-year average. Most lenders will take a 2-year average of your income. So, for example, if you make $20,000 in year 1 and $30,000 in year 2, they will take your income down as 25. There are some lenders who will take the latest year as long as it doesn't exceed the first year by too much. This is why having a specialist broker is important, because the broker needs to understand your situation and understand which lenders will be best suited to use to your circumstances. For example, you may need to choose a lender that uses the latest year to stretch the amount that you can borrow. Tip number 4. The latest year's income must be within 18 months. So please make sure you have your accountant in time when you're about to apply for a mortgage. Most lenders will not consider income more than 18 months old. Some lenders are even less. This applies to both your company accounts and your personal tax assessments. Personal tax is always considered from April to April. Tip number 5. The documents required for a mortgage are 2 years worth of accounts plus 2 years worth of your tax calculations with tax year overviews. Your accounts are the report that your accountant produces for the company, and your tax calculations are your personal tax summary, which includes the money earned and the type or source of income. The tax year overview is a summary of the tax owed and any tax already paid and the balance left, if any. Company accounts can start and end on any date of the year. Personal tax always runs from April to April. Lenders differ in terms of which year they work from, so again, it's important to have a specialist broker who will match your circumstances to the best lender. Hope you found this video useful. Any questions, or if you want any more information, then please put them in the comments or message directly. Thank you for watching and have a great day.